Okay, chapter 6, cash and receivables. So cash, being what it is the number one resource asset that you want to protect. So an enormous amount of internal controls are designed around controlling cash. And I teach a forensic accounting class at the graduate level in the summers. And in that class, we go over the multitude of ways people have invented over the years to steal cash. There are some very, very creative ways that have been that people have utilized in the past to drain cash off of a resource. So the definition of cash as the one line on the balance sheet, the very first line in the current assets section, because they're listed, as you recall, in order of liquidity. Cash is the most liquid. It's not just what's in your checking account, the unrestricted funds on deposit with a bank. And that includes any banks that are overseas. They get translated into U.S. dollars at a current currency exchange rate. Any coins and currency that you have on hand in all of your cash registers, because a lot of businesses run 24/7. So even at midnight on New Year's Day, there is businesses being conducted 13 hours ahead in China and 8 hours ahead in Europe that are open for business. And so they've got cash and currency going on. Any checks that you've received but not yet deposited, so you're getting receipts. Now granted, on New Year's Eve you're probably not getting much in the way of mail, but any checks that have not been deposited, as well as any credit card sales receipts. So whatever's in your cash boxes at midnight is what is included in cash. Also included, expanding that definition, the sinking funds that are set aside, as we know we've been classifying those, but they are considered cash if they're not in an investment vehicle. If you've just opened up a savings account to retire a bond someday and you're just depositing cash in there, then that's included in cash. Yes, sir.
I'm going to backtrack, but you said that credit receivables count as cash?
A credit card receipt.
Oh, credit card receipt.
Yeah, and that's also kind of an old definition because now you're just swiping it and it's all electronic. But it used to be that we had these little machines that we took imprints on, and there's some great stories about that. Things that can go wrong with an imprint machine. And so there's those are just like checks. You deposit them with your bank if they're MasterCard and Visa. If they're American Express or Discovery, then you mail them off, is what you used to do with them. But now it's all electronic. You swipe the card, it electronically transfers to the bank, and it gets deposited that night during clearing.
But that doesn't,
so that's considered cash. If you took a credit card receipt at 11:30 on New Year's Eve, then that's included in cash as of year end. All right, even though it won't clear and it won't show up in your bank account until the next day. Okay? Certificates, bank overdrafts, post-dated checks, travel advances, all of these are considered in the definition of cash. Most balance sheets also include cash equivalents. So you'll see on Boeing's balance sheet and Apple and all the big publicly traded companies, cash and cash equivalents. So cash equivalents are further expanded into highly, highly liquid securities. If you've got treasury bills, U.S. treasury bills, zero risk. If you're putting money in those just to earn a little bit of interest, that's considered cash. It's not a marketable security. Commercial paper is issued by large blue chip style companies, and it's a way to park cash overnight. They're very safe. You can buy commercial paper for IBM and GE and It used to be General Motors, but people don't buy those anymore. So it's really safe. You don't get much money, but you earn a little bit more money than Treasury bills pay. So it's a way to overnight or invest for a week or something like that with some excess cash. I used to use it in the aerospace business because I used to get large cash deposits in to work on an aircraft. And then my contract stated that I then had anywhere from 3 to 10 days to pay those deposits out to my subcontractors. And so I used to take those excess days and put it in commercial paper and earn a little bit of money on them. So, but that's an example. Internal controls are across the board, everything that you're going to put in place, the crosses and cross checks to ensure the accuracy of your financial statements. So it's not just limited to protecting physical assets. It's internal controls are there to make sure that sales don't get overinflated. Expenses are not understated. So there's internal controls for everything. And part of the Sarbanes-Oxley Act now, there's a Section 404 in Sarbanes-Oxley that requires all internal controls to be attested to by an external auditor. All right, so it made hundreds of millions of dollars of revenue for the public accounting firms worldwide because you now have to attest the public to internal controls. So cash, safeguarding receipts, counting a receipts by the person opening the mail or the salesperson using the cash register. Whoever opens your mail, and then when I was working, it was always the administrative assistant to the controller or the CFO. She would be the one that opened all mail. And you can kind of tell from the outside of the envelope if it's a check or not, because it kind of says paid to the order of above your address. So you can kind of tell what are checks. All checks went to her. She then opened them up and listed them. Provided a list of every check that came in. Once they were listed, she then would take them to the accounts receivable clerk for processing. All right? What I could do as part of my internal controls is match that list, because the accounts receivable clerk actually processed the check, the bank deposit. Once they got finished processing all the check, they would stamp them and endorse them on the back and then process it. That's changed even now, because now you've got these little scanners that you put at and it automatically deposits. You don't have to run to the bank anymore. So that person would make the deposit, and then I would look at the next day's cash receipts, the deposit made, and then check it to the list. And they needed to match. If they didn't match, my administrative assistant and my accounts receivable clerk had to explain to me why they didn't match. Okay? Because every once in a while, a check got, shuffled around on a piece of paper and, got stuck to the back and they didn't get to the bank. So that's the reason for this check. All right? So daily deposits of all receipts in the company's bank accounts, especially with cash, businesses that are high cash, They do night box deposits. You've probably seen them in the drive-thrus. There's these big round iron drum-looking things mounted to the side of the building. And so you get a key to that. And you can unlock that, and then you shove your envelope, big clear envelope with all your data on it, into that, and that gets processed the next morning. They run it through their count machines and then put it in your bank account. All right, so night drops. Payments also. The check stock should be locked up separate. Your accounts payable clerk, none of your clerks should have access to the check stock without your knowledge of it. Put it in a locked closet someplace. You have to unlock it and give them the check stock, count out how many checks that they're getting ready to run, and then you give that to them. Expenditures should have all the backup, and they're going to be asked. People are going to constantly hand you a check, want you to sign it. There's no backup. Oh, well, this is in a big hurry. The UPS guy's down at the loading dock, and he needs this check, or he's going to drive off, and we won't get the part, and we need the part to put on the airplane because the airplane's leaving this afternoon. I'm telling you, that's the story I heard throughout my career. Don't sign it. You've got to have the backup to it. Make sure that it's been properly authorized. The three-way match. If it's a part that's been ordered, I want to see the purchase order. I want to see the shipping document where we received it. And I want to see the invoice. And I want to make sure they match. Okay? So, it's all controlled. Electronic funds transfers, these are happening more and more and more nowadays. So you can see that that they're increasing from, and I don't know what these two dates are. It doesn't say on the graph, but you can see it's increased from 18% to over 51%. I mean, you do that yourself. You can pay bills electronically for CPS and the Time Warner bill and stuff like that. I just go onto my bank account and I tell them to pay the bill. It happens automatically. Just comes out of my checking account and it shows up as paid. All right, those are all electronic funds transfers. The accounts receivable version is a lockbox. So rather than mailing the checks to you, you mail them to a P.O. box that the bank controls. So your personnel never touch the checks. They will then produce the proper electronic signature to relieve your accounts receivable. So they do a lot of the work for you. And I've used them in the past. They're not perfect, but it's a way of getting this faster, because this process is faster than you getting them to your place of business, and then you run them, and then turn around and deposit them in the bank. It's just a way of speeding up cash flow. So receivables are basically broken into trade receivables. This is everything you sold to your customer on credit. It includes unsecured, which is accounts receivable, and secured, which is a promissory note. And you can convert them. If you've got a customer that is not paying on a timely basis, but you want to keep them as a customer, just approach them and say, listen, I'll let you keep buying from us, but everything that is older than 60 days, I want to convert to a promissory note. And I want you to start paying me interest on it. Not a lot, but I want you to pay me interest. And that promissory note is due, and you can negotiate terms. 3 equal payments of 30 days each, so 30, 60, 90 days, the promissory note will be paid off. So work with them, but get a legal document, because then if they get farther in trouble, you can take that promissory note to court. And now you stand in line before the unsecured trade receivables. Okay? Non-trade receivables are everything else. I mean, you've got advances to employees. You've got things that are, you loan money to officers and moving expenses and stuff like that. But they're not related to your day-to-day business, non-trade. They're still current assets because you expect them to be paid back to you, expect to convert them to cash in the next 12 months, but they're not arising from sales. Revenue recognition, we've talked to death. Let's see. Okay, trade discounts. We talked about this a little bit when we were going over the multi-step income statement. This is the 210 net 30 example. All right? So 210 net 30 here is if you pay within 10 days, you can have 2% discount off of the invoice. Otherwise, the whole invoice, 100% of the invoice, is due in 30 days. Well, like many ways, I mean, you do this to speed up cash flow. Customers will like taking these, and I frequently have had customers take advantage of this. There are 2 ways of recording it. Like many things in U.S. GAAP, there's options. The gross method and the net method. The gross method is just like we've been doing. When you sell an invoice on credit, you book 100% of it to accounts receivable and to sales. The credit is to sales, to revenue. Then, if within the 10 days they pay the discount, you then take a contra sales revenue account, will be your part of your debit. So what you debit cash for, let's keep it simple, and there's an example here in a second. Let's just get to that, and that'll make it easier. All right, so you've got two sales. Under the gross method, this is what you guys have been doing since Principles 1. You debit accounts receivable, credit sales revenue for $8,000. If they pay within 10 days, all right, you recorded this on the 1st of December. If they take the discount, then you're going to debit cash for the balance. This is a partial payment. So $5,500 is what they're paying in invoices, but they're paying it within the discount. So sales discounts taken and then relieve the accounts receivable for the $5,500. Then they make another payment after the discount date, and at that point you recorded it, debit to cash, credit to receivables. All right? This is the gross method. The net method is that you net out as if 100% of every customer is going to take the discount. So rather than the full $8,000, you only record sales revenue of $7,840, which is less the $160 discount that is available. All right, does this make sense so far? Then, when they pay within the discount period, it's just a debit to cash and a credit to accounts receivable. If they don't pay within the discount, now you have a sales discount not taken. And when we get to purchasing and inventory, I always take the net method when I'm buying stuff, because I want to track how many discounts were available to me that I did not take advantage of. All right? This one's useful, really, either one of them's a viable method. This is the way I normally do it as far as receipts, is the gross method. All right? But both options are available under US GAAP. Sales returns versus allowance, we talked about. If they're not going to physically return the good back to you, the seller, then it's an allowance. This is for little bottles of water, apples, peaches, plums, that go rotten. I don't want them back. If I'm the orchard, you can keep them. I'll give you the allowance for it. So sales returns, you just hit that contra sales account and create an allowance. So that's what that is. All right. Uncollectible accounts. There's two major alternatives, either an allowance method or a direct write-off method. You either match the bad debts to the sales during the period by estimating how much of your sales, credit sales, are you not going to collect. All right? And then under this, you'll see here in a second, there's a couple of options, further options, to calculate this allowance. Or, if you really don't have much in the way of bad debts, you can take the direct write-off method. But you're going to have to argue, because you're not matching at that point. You're not fully expensing all of the incurred expenses in the period in which your sales are generated. Because only when you identify a specific customer, you write it off to bad debt. A debit to bad debt and a credit to accounts receivable. Because you expect to collect everything. And I have successfully argued this. I talked about it in this class before. If you're an OEM and you're manufacturing parts for an aircraft and they're still flying that aircraft, you do not have a bad debt. Because if they stop paying you, you will stop supplying parts to the airplane and they can't fly it. So they're eventually going to pay you. All right? So you can use this, but it's rare. The allowance method is what most people do, and this can be based upon either an analysis of your existing accounts receivable, or it can be based on a percentage of your current sales. Both methods are acceptable. So either you're going to estimate based upon how much your balance in receivables are, and there's two methods under that we'll talk about here in a second, or you're going to multiply it by the current sales. When you're using an allowance, what was that? Is that my phone? Oh, it was yours, okay. I thought the robot was going off on an alarm or something. When you're using an allowance method, you're going to debit bad debt expense and credit the allowance for doubtful accounts. And this has got a multiple name, so it depends on the company's chart of accounts. Sometimes it's called the allowance for bad debts. Sometimes it's called the allowance for uncollectible accounts. For this class, we'll use the allowance for doubtful accounts. All right? So, either a relationship to credit sales, a percentage of net credit sales, or the balance sheet approach, which is a percentage of total outstanding accounts receivable. You got $1 million worth of accounts receivable, and historical analysis tells you that you're not going to collect 2% of that. So you take $20,000 as bad debt. All right? Or, and this is what we're going to be testing on the midterm, you do an aging of accounts receivable. You break up your accounts receivable into aging. How much of your total accounts receivable was sold in the last 30 days? In other words, it's still current. If they owe you within 30 days, all of these invoices are still within the period of time that you expect them to be paid. And then you do 31 to 60. Okay, some people haven't paid you, but they're only a month behind. No reason to panic. 61 to 90. You might want to get a hold of the salesperson for these guys. Find out what's going on. 91 to 150 or 180 days. If they haven't paid you within 6 months, something's really wrong. Okay? So, under that logic is that the invoices that are within the last 30 days, you're going to collect the bulk of that. Maybe 100% of those. 99.5% or 99%. The stuff that is only a month old, still 94, 95% of that. 3 months old, maybe 80. 6 months old, 30. Beyond a year, 5% maybe you might eventually collect. Who knows? So that's what the approach is, and that's the one that makes most sense. And it's not hard. You just got to come up with an estimate for each one of those aging columns and then multiply it out. All right? And that's what we'll be doing on the second midterm. All right, let's go over them one at a time. The percentage of credit sales. You sold $525,000 worth of sales during the past year. Historically, you've not collected 2% of that. Multiply it out, $10,500, debit to bad debt expense, credit to the allowance for doubtful accounts. When you're taking this approach, it doesn't matter what your existing balance is for the allowance. Okay? It doesn't matter. You could have a leftover credit balance in that contra asset account, or you could have used up too much of it last year by writing off actual accounts. It's always just going to be 2% of sales. That's going to differ when we take the balance sheet approach. If we determine that the ending balance is, we have a credit balance of $4,500 at the end of the year. There's been an actual relationship of 4% and the end of the year balance. So rather than 2% of credit sales, we've got $475,000 of accounts receivable at year end. Historically, we don't collect 4% of that. However, we have some left over, because if it's a credit balance, that means whatever our estimate was at the end of last year, we have not written off all of it. Because what happens when you identify a customer that's not going to pay you? They've gone, they've shut down, they've moved to the Bahamas. You're never going to see them again. What entry do you make? Well, you've got to credit the accounts receivable balance, right? To get it out of your accounts receivable ledger. They're never coming back. There's no sense in leaving it on there. Well, no, because you took the bad debt when you estimated it. The allowance for bad debt. So you've been chipping away at this allowance throughout the year as you've identified customers that are not going to pay you, and you've written them off. At the end of the year, in this particular case, you have $4,500 left over because it's a credit balance. What if it was a $4,500 debit balance? What happened? You underestimated at the end of last year how much was going to be bad debt. And you've written off more because you've been debiting the allowance for bad debt and crediting accounts receivable throughout the year as you write off these specific accounts. All right? So in this case, there's a credit balance. So you take the balance, you need $19,000. That's the 4% of $475,000. Compare it to the current balance, and your entry is the difference. So when you're doing the balance sheet approach, whether it's a single percentage of the entire balance or it's the aging, you always take into account how much is left in the allowance account from last year. All right? So your debit is the bad debt expense, $14,500, and credit to the allowance for bad debt, $14,500. Aging. You've got a total of $121,800, and it's from these 5 companies: Goodwin Company, Hobson, onwards. Under 60 days, you've got $21,000 from Goodwin, and then beyond 2 months, so your terms here are 60 days. You're in the aerospace business. So you're giving them 2 months to pay you. So these are all current. These are non-current, but they're not too bad. And then we got somebody out here, Hobson Company. They haven't done any business with you in the last year, and they owe you $14,500. What's the chances of you getting that money? Minimal. So what you're going to do is you're going to estimate, based upon the aging, everything that's under 60 days, you're going to lose maybe 2% of that because it's current. Beyond that, 2 months to 4 months, 8%. 4 months to 6 months, well, 240 is 7 months, 15%. 30%, and then over a year, and that's going to be a hard sell. If somebody hasn't paid you in a year, proving to your auditors that 50% of that is still going to be collected might be a little bit of a hard sell. Yeah.
So I mean, I guess going on from there, what do you do? Is there just no way that you're going to get that money? Can you?
You don't know. I mean, they may all of a sudden show up and say, "Listen, we're emerging from bankruptcy." I go, "Well, that's wonderful. Pay me." Well, no, we got relief from bankruptcy. Great. Go find your stuff elsewhere. I'm not doing business with you. So, because during bankruptcy you get relief.
Great.
I don't believe that. That's great. Come up with a payment. We'll take that $14,000. We'll put it in a promissory note. Now, the next time you go into bankruptcy, I'll be first in line, and I make them pay me. And I've had people do it. You know? Otherwise, send them, let them be somebody else's problem. You don't need that. Okay? All right, so you take that, you come up with a total estimate of uncollectible based upon this gradated scale. So total is $16,000. This is the same thing we did last time. Compare, that's what the balance needs to be in the allowance for doubtful accounts. So take the rest of it to someplace else. So here's the, well, that's a write-off. Okay, if it has a current credit balance of $1,350, once again, you didn't use it all last time. It needs to be $16,000. Your debit to bad debt expense for the current year is $14,980. And we'll be doing problems for this on Monday. All right, I talked about this. When you actually write off $1,000, you debit the allowance, credit the accounts. What happens if somebody pays you and you've already written them off?
You go back and reverse it.
You got to reverse it first. So you're going to put it back in the accounts receivable because you can't process the check if it's not in the accounts receivable module. So you're going to restore their account, lower the or increase the allowance for bad debt again by crediting it, and then you can process normally the cash receipt by debiting cash and crediting accounts receivable. But you got to get it back in that module first because otherwise your accounts receivable has got nothing they can do with that check. And that does happen on occasion. Yes, sir.
Would you do that immediately or would you wait for adjusting entries?
No, the minute it comes in the door because you can't process that check. Okay. You know, your accounts receivable clerk comes and it goes, I got a payment for something and it's not in the system. Oh, well, that's good. What's it for? And then you go look up and you see that it's somebody that you've written off. Okay? Notes receivable, I've talked about. Short-term note receivable. They can either be interest-bearing or non-interest-bearing. All right, if somebody owes you $10,000, you can either charge them 4% for the next 90 days on the $10,000, or you can just say, pay me $10,000. The problem with the pay me $10,000 is U.S. GAAP requires that you accrue interest. Nobody gets a free lunch. So in that case, what you have to do is discount back. So this is a 12% note. So you're sold a piece of equipment, accepted a 60-day 12%. You debit notes receivable rather than accounts receivable because it's a little bit more liquid. You can take it to court and then credit your sales revenue. And then when you receive the cash, they've got $100 worth of interest that you've earned on that, on the 12%, and you debit the note receivable, debit cash, credit the note receivable, credit interest revenue. Right, it doesn't come up with the non-interest bearing note, but we won't worry about that. But there are non-interest bearing notes and you have to accrue. We will get to those when we get to current liabilities. Because when you're buying a piece of equipment on a non-interest bearing note, you have to go to your present value tables and you have to accrue interest on it. All right? All right, the last topic is bank reconciliations. And I'm going to emphasize this. We're going to do problems on Monday, and it is going to be on the midterm because I find that there's a lot of accountants out there that can't do a bank rec, and I don't know why. They're not complicated. You have two balances to do a bank reconciliation. Does anybody do a bank reconciliation of their personal account? It seems to be a lost art. At the end of every month when you get your bank statement, do you go and look at it and compare it to your checkbook and reconcile it? You ought to at least look at it. Because if the bank's made a mistake, and they do make mistakes, you only have, depending upon your agreement with your bank, anywhere from 30 to 60 days to find that mistake and tell them about it. If you don't find it in that period of time, they don't owe you the money. So you ought to look at it at a minimum. All right, you've got the book balance. That's what your cash disbursements journal says. So as you've been spending money, you've been sending out accounts payable checks, you've been issuing payroll. As you've been sending these checks out, you've been deducting it from the bank balance, right? You've been debiting accounts payable and crediting cash. You've been debiting salaries expense and crediting cash as you've been sending these checks out. The bank has a different balance because there's timing differences. There are checks that you have sent to your suppliers that they've not yet cashed. Well, your bank has no way of knowing about those checks. How would they know? Until the check is presented. There are deposits that you make on the last day. It's included in your cash balance because you've received the check that day, but it wasn't deposited until after the bank closed. You know, that you put it through the night drop. Well, that's your cash. You earned it, but they don't know about it yet. They won't know about it till the next day. It's not on your bank statement. There are charges that the bank is charging you that you won't know about until you get the check statement. Because in a commercial account, it's a little more complicated. I mean, you can get a personal account and they'll just charge you $5 a month or $2 a month to have the account. And it's standard. You know what it is, month in and month out. Commercial account, they charge you so much for every check that's deposited, every check they process, every check you write. It is a fee based upon activity. So it varies from month to month, depending upon how many checks you wrote or how many checks you deposited or how many times you called them on the phone or all sorts of things. And then there are charges that the bank only knows about. Somebody gave you a check, you process it, it's in your cash balance, you debited cash and credited accounts receivable, and it was NSF. Do you all know what NSF is? Hopefully not. Hopefully you've never had that happen to you. Non-sufficient funds. It bounced. There was not enough cash in the bank to cash that check, so they sent it back. Well, you won't know about it until the bank sends you that NSF check. All right? And then there are errors that occur. And it happens. A check for $450 or $540 accidentally gets entered into the system at $450. Right? It happens. Well, that's $90 out of your pocket if you don't catch it. All right, so you start with two different balances, the bank balance and the book balance. They don't match. You're going to make adjustments to both. So what I'm going to do on the board and what I do on paper is I put, at the top half of the book of the paper I put the bank balance, and then the bottom half of the paper I put the book balance, and then you work towards the middle. And you chip away the differences. And the decision is, of every adjustment that you're presented, who knows about it? Because the person who doesn't know about it, if it's the company or the bank, you've got to adjust that number. So if it's an NSF check, you didn't know about it. It was in your book balance. It needs to come out of your book balance because it wasn't collectible. If it's a check in transit, you've written the checks, you've mailed them out, you know about them, it's in your company book balance, but the bank doesn't know about it. So it's an adjustment to the bank. Does that make sense? It'll make a lot more sense when we actually start doing it rather than talking about it. All right, so that's the way it works. So these three checks were outstanding, and coming up with it, you just take your check register and you go through the bank statement and you look at every check number and you look at every amount and make sure they match, and then you check them off. Those are the checks that cleared during the month. Then you take what's left And then there was an error. There was a check that was written for $91.20, but the bank accidentally recorded it as $19.20. There's a transposition error there. So, you take the bank balance, you add in any deposits that you've made that they don't know about, any cash that you have on at midnight. Those are the adds. You deduct the checks that you've written that they don't know about yet because your vendor has not yet presented them yet. So you subtract those from the bank balance and you get an adjusted cash balance, $13,424. Then what are the items that you didn't know about? Well, you presented a note receivable to the bank. It's a legal document. That bank contacted the signer's bank, the customer that gave you that note, contacted their bank and collected it for you. It's part of the services. So bank to bank, they collected this note, plus the interest. Well, you need to add that because you didn't know about it until the bank told you about it. Sometimes they take a week, sometimes they take a month to collect these darn things. The bank service charge, the check that's been returned, and then the error that was made on the check. All of those get adjusted to the company's book records, and then that comes up with an adjusted balance. Same, $13,004, and that's the reconciliation. Any adjustment that you made to your side, to the book, requires a journal entry. You've got to record the receipt of the note, so debit cash for the $1,212, credit the note receivable for the balance of the note receivable, and then credit interest revenue. Miscellaneous expense for the bank charge is the debit. You've got to put the bad check, the bad debt, NSF, back into the receivable because you're going to presumably contact your customer and yell at them and say, what happened? I need a new check. And then you got to correct the accounts payable for the check that was recorded in error. All right? That's it. That's a bank rec. Questions? All right. Don't forget, tomorrow night,